quick note: this is for educational purposes only and not financial advice. Any decisions you make are your own responsibility, and trading involves risk. Position sizing is where trading stops being theoretical and becomes real. This is the point where your ideas meet capital and your decisions begin to have tangible financial consequences. Most traders spend an overwhelming amount of time obsessing over entries, indicators, and setups, yet the single most important determinant of long-term performance is not where you enter, but how much you allocate. This is where professionals separate themselves from amateurs. At its core, position sizing is about translating conviction into exposure while maintaining control over risk. It is the mechanism that determines whether a good idea generates meaningful returns or whether a bad sequence of trades leads to irreversible damage. If you mismanage position sizing, even a strong edge will not save you. Conversely, if you manage it correctly, even a modest edge can compound into significant capital growth over time. The first principle to internalize is that position sizing is not about maximizing profits. It is about optimizing risk-adjusted returns. That distinction is critical. When traders think in terms of maximizing profits, they tend to increase size aggressively during periods of confidence, often at precisely the wrong time. When they think in terms of optimizing risk, they focus on consistency, survivability, and controlled growth. Institutional traders never ask, "How much can I make from this trade?" They ask, "How much can I lose if I am wrong? And how does that loss fit within my overall portfolio risk?" This shift in thinking changes everything. It removes emotional bias, and it creates a structured framework for decision making. Another key concept is that position sizing must be systematic. It cannot be arbitrary or emotionally driven. If your sizing changes based on how you feel, your results will be inconsistent and unpredictable. Professional traders use predefined rules, often based on volatility, conviction, and portfolio context, to determine position size before the trade is even executed. You must also understand that position sizing is dynamic. It evolves with your capital, your performance, and market conditions. What is appropriate in a low volatility environment is not appropriate in a high volatility regime. What is appropriate after a drawdown is not appropriate after a period of strong performance. Ultimately, position sizing is the bridge between your strategy and your results. It is the mechanism through which edge is expressed. Without it, even the best ideas remain theoretical. With it, you begin to operate like a professional, managing capital with precision, discipline, and intent. To understand position sizing properly, you need to begin with a simple but powerful concept: risk per trade. This is the foundation upon which all professional sizing frameworks are built. Risk per trade defines how much of your capital you are willing to lose if a trade does not work out as expected. Notice the wording carefully. It is not about how much you are investing. It is about how much you are risking. These are not the same thing. You could allocate a large amount of capital to a trade, but have a tight stop loss, resulting in a small defined risk. Alternatively, you could allocate a smaller amount but allow a wide stop, creating a larger risk exposure. Professional traders think in terms of risk units, not capital allocation. A common approach is to define risk as a percentage of total capital. For example, risking 1% per trade means that if the trade fails, you lose 1% of your account. This creates consistency and allows for controlled drawdowns. The reason this matters is because losses are inevitable. No strategy has a 100% win rate. By controlling risk per trade, you ensure that a sequence of losses does not wipe out your capital. This is directly linked to the concept of survival, which underpins everything in trading. Another important aspect is that risk per trade should remain consistent, especially during the early stages of developing a strategy. If you vary your risk arbitrarily, you introduce noise into your results. You make it difficult to evaluate performance, and you increase the likelihood of emotional decision making. However, consistency does not mean rigidity. As you gain experience, you may adjust risk based on conviction or market conditions, but these adjustments must be rule-based, not emotional. For example, you might risk slightly more on high conviction trades that align with multiple factors and less on lower conviction setups. The key is that every trade has a predefined risk before it is entered. There is no ambiguity, there is no improvisation. This creates clarity, reduces stress, and allows you to focus on execution rather than reacting to outcomes. When you master risk per trade, you gain control over your downside, and once your downside is controlled, you create the conditions necessary for long-term profitability. Once risk per trade is defined, the next layer is understanding how position size is actually calculated. This is where many traders become confused because they focus on the size of the position rather than the structure of the trade. Position size is a function of three variables: your account size, your risk per trade, and your stop loss distance. These three elements work together to determine how much you should allocate to a trade. Start with your account size. This is your total capital base. From this you define your risk per trade, typically as a percentage. For example, if you have 100,000 and you risk 1%, your maximum loss per trade is 1,000. Next comes the stop loss. This defines how much the market can move against you before you exit the trade. The distance between your entry and your stop determines how much price movement you are willing to tolerate. Now, here is the critical insight. The wider your stop loss, the smaller your position size must be to maintain the same level of risk. Conversely, the tighter your stop, the larger your position size can be. This relationship ensures that your risk remains constant regardless of the trade structure. It also forces discipline. You cannot simply increase position size without considering the implications for risk. Professional traders always calculate position size based on these variables before entering a trade. There is no guesswork, there is no approximation, everything is defined in advance. This process also highlights why entry is less important than most traders think. You can have a slightly imperfect entry, but if your risk is controlled and your position size is appropriate, the trade can still be managed effectively. On the other hand, a perfect entry with poor sizing can lead to significant losses. This is why position sizing is often referred to as the engine of trading performance. It determines how outcomes translate into capital changes. When you internalize this framework, you begin to see trades differently. You stop thinking in terms of potential profits and start thinking in terms of controlled risk and structured exposure. That shift is fundamental to professional trading. Another critical dimension of position sizing is volatility. Markets are not static. They expand and contract, sometimes gradually, sometimes violently. If your position sizing does not adapt to these changes, your risk becomes inconsistent, even if your nominal risk per trade remains the same. Volatility determines how much price moves within a given period. In a low volatility environment, price movements are relatively contained. In a high volatility environment, price can move significantly in a short amount of time. If you use the same position size in both environments, your actual risk exposure changes. In high volatility, the market can hit your stop more easily or move against you more aggressively. This increases the likelihood and magnitude of losses. Professional traders address this by incorporating volatility into their sizing models. One common approach is to adjust position size based on the average range of price movement. When volatility increases, position size decreases. When volatility decreases, position size can increase. This creates a stabilizing effect. It ensures that your risk remains consistent across different market conditions. It also reduces the likelihood of being caught off guard by sudden market moves. Volatility-based sizing also aligns with the reality of market regimes. During periods of uncertainty or macro shifts, volatility tends to increase. Reducing position size during these periods is not a sign of weakness, it is a recognition of increased risk. Conversely, during stable conditions, when volatility is low and trends are more predictable, you may be able to allocate slightly more capital without increasing risk disproportionately. The key is that position sizing is not static, it must respond to the environment. This requires awareness, discipline, and a structured approach to measuring volatility. When you integrate volatility into your sizing decisions, you move closer to institutional practice. You stop treating all trades as equal, and you begin to account for the underlying dynamics of the market. Conviction is another factor that influences position sizing, but it must be handled with extreme care. Many traders misuse conviction as a justification for increasing risk, often based on subjective confidence rather than objective analysis. In a professional context, conviction is not a feeling, it is a structured assessment based on multiple aligned factors. These may include macro conditions, market structure, sentiment, and technical confirmation. When these elements converge, the probability of a favorable outcome may increase. However, even in high conviction scenarios, uncertainty remains. There is no such thing as a guaranteed trade. This is why position sizing must still be anchored in risk control. Professional traders may scale position size based on conviction, but within predefined limits. For example, a standard trade might risk 1%, while a high conviction trade might risk 1.5%. The increase is measured, not excessive. This approach allows you to express your edge more effectively without exposing yourself to disproportionate risk. It also ensures that a single trade, regardless of conviction, cannot cause significant damage. Another important point is that conviction should be earned, not assumed. It should be based on a repeatable process, not intuition alone. If your conviction is not grounded in a structured framework, it is likely to be biased. You must also be aware of the psychological risks. Increasing position size can amplify emotional responses. Even if the trade is well structured, the larger exposure can create stress, leading to poor decision making. This is why many professional traders prefer to keep position sizing relatively stable, using conviction more as a filter for trade selection rather than a driver of size. Ultimately, conviction is a tool, not a license. It should enhance your decision making, not override your risk framework. When used correctly, it allows you to allocate capital more efficiently. When used incorrectly, it becomes a source of risk. Position sizing does not exist in isolation. It must be viewed within the context of your overall portfolio. This is where many traders make a critical mistake. They size individual trades correctly, but fail to consider how those trades interact with each other. If you have multiple positions that are highly correlated, your effective risk is higher than it appears. For example, if you are long several assets that all depend on the same macro driver, a single adverse event can impact all of them simultaneously. Professional traders manage this by looking at aggregate exposure. They consider how different positions are related, and they adjust sizing accordingly. This may involve reducing size on individual trades to ensure that total portfolio risk remains within acceptable limits. Another aspect is diversification. By spreading risk across uncorrelated or weakly correlated assets, you reduce the impact of any single outcome. This allows for more stable performance over time. However, diversification must be meaningful. Simply having multiple positions does not guarantee reduced risk. What matters is how those positions behave relative to each other. Position sizing at the portfolio level also involves managing overall risk limits. For example, you might have a rule that total risk across all open positions cannot exceed a certain percentage of your capital. This creates a cap on exposure and prevents overextension. This is particularly important during periods of high opportunity. When markets are active, there may be many attractive setups. Without a portfolio framework, it is easy to overcommit and take on excessive risk. Professional traders prioritize capital preservation over opportunity maximization. They understand that there will always be more trades. The goal is not to capture every opportunity, but to participate in the best ones while maintaining control over risk. When you think in terms of portfolio risk, position sizing becomes more than a trade level decision. It becomes part of a broader capital allocation strategy aligned with long-term objectives. Another key concept in position sizing is compounding. This is where the power of consistent controlled risk becomes evident over time. Compounding is the process by which your capital grows and your position sizes increase proportionally. If you risk a fixed percentage of your capital on each trade, your absolute risk increases as your account grows. This allows you to scale your edge without increasing your relative risk. For example, if you start with 100,000 and risk 1% per trade, your risk is 1,000. If your account grows to 150,000, your 1% risk becomes 1,500. This is how growth accelerates. However, compounding works in both directions. During drawdowns, your position sizes decrease, reducing your exposure and limiting further losses. This creates a natural stabilizing effect. This dynamic is essential for long-term survival. It ensures that your risk adjusts automatically based on performance. You are not overexposed during losing periods, and you are able to scale during winning periods. The key to effective compounding is consistency. If you deviate from your risk framework, you disrupt the compounding process. For example, increasing risk after a series of wins can lead to large losses if the sequence reverses. Professional traders respect the compounding process. They allow it to work over time rather than trying to accelerate it through aggressive risk-taking. This requires patience and discipline. The growth may seem slow initially, but over time it becomes significant. This is the difference between sustainable performance and short-term volatility. When you understand compounding, you begin to see trading as a long-term process. Each trade is a small part of a larger journey. Position sizing ensures that this journey is controlled, consistent, and aligned with your objectives. Drawdowns are an inevitable part of trading, and position sizing plays a central role in how they unfold and how they are managed. A drawdown is a decline in your capital from a peak to a trough. The depth and duration of drawdowns are heavily influenced by your risk per trade. If your position sizes are too large, drawdowns can become severe. Recovering from large drawdowns is mathematically difficult. For example, a 50% loss requires a 100% gain to recover. This is why controlling downside risk is so critical. By keeping risk per trade at manageable levels, you limit the impact of losing streaks. Even if you experience multiple consecutive losses, your capital remains largely intact. This allows you to continue trading and eventually recover. Another important aspect is the psychological impact of drawdowns. Large losses can lead to frustration, fear, and impulsive behavior. This often results in further losses, creating a negative cycle. Proper position sizing helps to mitigate this. When losses are controlled, they are easier to accept. This allows you to maintain discipline and stick to your strategy. Professional traders expect drawdowns. They plan for them. Position sizing is the mechanism that ensures these drawdowns are survivable. It is also important to adjust position size during drawdowns. Reducing risk slightly can help stabilize performance and prevent further losses. This is not about abandoning your strategy, it is about adapting to current conditions. When you manage drawdowns effectively, you protect your capital and your psychological state. This creates the foundation for long-term success. Ultimately, position sizing is about control. It is the mechanism through which you manage uncertainty, express your edge, and protect your capital. Without it, trading becomes unpredictable and unsustainable. The goal is not to find the perfect position size. It is to develop a framework that is consistent, adaptable, and aligned with your objectives. This framework should define how much you risk, how you adjust for volatility, how you account for conviction, and how you manage portfolio exposure. Every decision should be made before the trade is executed. There should be no ambiguity. This reduces emotional interference and allows you to focus on execution. You must also accept that position sizing is a skill that develops over time. It requires experience, reflection, and continuous refinement. You will make mistakes. The key is to learn from them and improve your framework. Professional traders treat position sizing as a core competency. It is not an afterthought. It is central to their process. When you master position sizing, you gain control over your outcomes. You reduce the impact of randomness and you create the conditions for consistent performance. This is where trading begins to feel different. Less chaotic, more structured, less emotional, more deliberate. And that is the point where you start to operate not as a participant, but as a professional managing risk with precision. Scaling into positions is a technique that, when used correctly, allows you to refine exposure over time rather than committing all capital at a single point. This is particularly relevant in environments where uncertainty is high or where price discovery is still unfolding. Instead of treating a trade as a binary decision in or out, professional traders often build positions progressively. The logic behind scaling is simple. You do not need to be perfectly right at the exact moment of entry. Instead, you can enter partially, observe how the market behaves, and add to the position as the thesis begins to validate. This reduces initial risk while preserving the ability to participate in the full move. However, scaling must be structured. It is not averaging blindly or reacting emotionally to price movement. Each addition to the position should be pre-planned based on specific criteria such as confirmation of direction, improved risk-reward, or changes in market structure. There are two primary approaches to scaling, known as scaling into losers, scaling into losers. Scaling into winners is generally preferred as it aligns with the principle of letting winning trades grow. As the market moves in your favor, your risk reduces and you can increase exposure without increasing initial risk. Scaling into losers, often referred to as averaging down, is far more dangerous. While it can work in certain structured strategies, it requires strict risk controls and a deep understanding of the underlying drivers. Without this, it can quickly lead to significant losses. Position sizing plays a critical role here. Each addition must fit within your overall risk framework. You are not increasing risk arbitrarily, you are reallocating exposure as the trade evolves. This approach reflects how institutions operate. They rarely deploy full size at once. They build positions over time using liquidity and market behavior to optimize execution. When you understand scaling, you move away from the idea of a single perfect entry. Instead, you think in terms of position construction. This is a more flexible, adaptive way of engaging with the market. Scaling out of positions is equally important and often overlooked. Just as you can build a position progressively, you can also reduce it progressively. This allows you to manage risk, lock in profits, and adapt to changing market conditions. One of the key challenges in trading is knowing when to exit. Many traders either hold too long and give back profits, or exit too early and miss potential gains. Scaling out provides a middle ground. For example, you might take partial profits at predefined levels, reducing your exposure while keeping a portion of the position open. This allows you to secure gains without completely exiting the trade. This approach also reduces psychological pressure. Once part of the position is closed, the remaining exposure feels less significant. This makes it easier to let the trade run without emotional interference. However, scaling out must also be structured. It should be based on predefined rules, not reactive decisions. These rules may be linked to technical levels, volatility thresholds, or changes in the underlying thesis. Another important consideration is the impact on risk-reward. By taking partial profits, you may reduce the potential upside of the trade. This is a trade-off. The benefit is increased consistency and reduced volatility in your equity curve. Professional traders often prioritize consistency over maximizing individual trade outcomes. Scaling out aligns with this philosophy. It also integrates with broader portfolio management. By reducing exposure on one trade, you free up capital for other opportunities. This creates flexibility and improves capital efficiency. Ultimately, scaling out is about control. It allows you to manage outcomes more precisely, rather than relying on a single exit point. One of the most important mistakes traders make is increasing position size after a series of losses. This behavior is often driven by a desire to recover quickly, but it introduces significant risk. When you increase size after losses, you are effectively betting more at a time when your strategy may not be performing well. This amplifies drawdowns and increases the likelihood of further losses. Professional traders do the opposite. They reduce risk during drawdowns. This allows them to stabilize performance and protect capital. This concept is closely linked to the idea of risk of ruin. If your losses are too large, or if your risk per trade is too high, you increase the probability of depleting your capital to a point where recovery becomes impossible. Position sizing is the primary tool for managing this risk. By keeping risk per trade at controlled levels, you ensure that even a sequence of losses does not lead to catastrophic outcomes. Another important aspect is maintaining consistency. If you change your position size based on recent outcomes, you introduce variability into your results. This makes it difficult to assess whether your strategy is effective. You must separate performance from execution. A losing streak does not necessarily mean your strategy is flawed. It may simply be a normal part of the distribution of outcomes. By maintaining consistent position sizing, you allow your edge to play out over time. You avoid overreacting to short-term results. This discipline is difficult to maintain, especially during periods of underperformance. However, it is essential for long-term success. Position sizing is not just a mathematical tool. It is a behavioral framework. It enforces discipline and prevents emotional decision-making. On the opposite side, increasing position size after a series of wins can be equally dangerous. This behavior is often driven by overconfidence. Traders feel that they have found a rhythm or that the market is favoring their approach. While it may seem logical to increase size during winning periods, this can lead to significant losses if the sequence reverses. Markets are cyclical. What works in one environment may not work in another. Professional traders understand this. They do not assume that recent success will continue indefinitely. Instead, they maintain consistency in their risk framework. This does not mean that position size never increases. As discussed earlier, compounding naturally leads to larger absolute position sizes as capital grows. However, this increase is controlled and proportional. What is avoided is discretionary increases based on confidence alone. These are often poorly timed and driven by emotion rather than analysis. Another risk is that larger position sizes can distort decision making. When more capital is at stake, traders may become more sensitive to price movements. This can lead to premature exits or hesitation. By keeping position sizing consistent, you maintain stability in your process. You reduce the influence of psychological factors and allow your strategy to operate as intended. This discipline is what differentiates professional traders from those who are driven by short-term results. Position sizing should reflect your framework, not your recent performance. This ensures that your approach remains robust across different market conditions. A critical concept in professional trading is the idea of asymmetry. This refers to the relationship between potential reward and potential risk. Position sizing plays a key role in exploiting asymmetric opportunities. An asymmetric trade is one where the potential upside significantly exceeds the downside. For example, risking 1 unit to potentially gain 3 units. These opportunities are the foundation of long-term profitability. However, asymmetry alone is not enough. You must size positions appropriately to capture this advantage. If your position size is too small, the impact of winning trades is limited. If it is too large, the risk becomes excessive. The goal is to align position size with both the probability of success and the magnitude of potential outcomes. This requires a nuanced understanding of your strategy and the market environment. Professional traders often prioritize trades with strong asymmetry. They may allocate more capital to these opportunities within their risk framework. This is where position sizing becomes a tool for capital allocation. It allows you to direct resources towards the most attractive opportunities while limiting exposure to less favorable setups. Another important aspect is that asymmetry is not static. It can change as the trade evolves. For example, as a trade moves in your favor, the remaining upside may decrease relative to the risk. This is where dynamic position management becomes important. You may choose to reduce exposure as asymmetry decreases, locking in gains while maintaining some participation. Understanding asymmetry and its interaction with position sizing is essential for developing a professional trading approach. Another layer of sophistication in position sizing comes from understanding expectancy. Expectancy is the average outcome of a trade, taking into account both the probability of winning and the average win and loss sizes. While we will explore expectancy in greater detail later, it is important to understand how it relates to position sizing. Your position size determines how expectancy translates into actual capital growth. If your strategy has positive expectancy, consistent position sizing allows that edge to compound over time. If your position sizing is inconsistent, you distort the expression of that expectancy. For example, if you take larger positions on losing trades and smaller positions on winning trades, your effective expectancy becomes negative, even if the underlying strategy is sound. This is why consistency in position sizing is so important. It ensures that your results reflect the true performance of your strategy. Professional traders design their sizing frameworks to align with their strategy's characteristics. They understand the distribution of outcomes and adjust their risk accordingly. This may involve using different position sizes for different types of trades based on historical performance and confidence levels. However, these adjustments are always grounded in data and structured analysis. They are not based on intuition alone. When you align position sizing with expectancy, you create a coherent system. Your strategy and your risk management work together rather than in conflict. This integration is a hallmark of professional trading. Liquidity is another critical factor that influences position sizing, particularly for larger accounts. Liquidity refers to the ability to enter and exit positions without significantly impacting the market price. In highly liquid markets, such as major currency pairs, large positions can be executed with minimal slippage. In less liquid markets, even relatively small positions can move the price. If you ignore liquidity, you risk entering positions that you cannot exit efficiently. This can lead to worse execution, increased costs, and higher risk. Professional traders always consider liquidity when determining position size. They ensure that their trades can be executed within the available market depth. This may involve breaking orders into smaller parts, using different execution strategies, or limiting position size to avoid market impact. Liquidity also affects stop-loss execution. In low liquidity environments, price can gap through stop levels, resulting in larger losses than expected. By accounting for liquidity, you create a more realistic assessment of risk. You move beyond theoretical models and consider actual market conditions. This is particularly important during periods of stress, when liquidity can deteriorate rapidly. In such environments, reducing position size is often necessary. Understanding liquidity and its impact on position sizing is essential for managing real-world trading risk. Transaction costs are another often overlooked component of position sizing. Every trade involves costs, including spreads, commissions, and slippage. These costs can have a significant impact on performance, especially for strategies with high turnover. If your position sizes are too small, transaction costs can erode a large portion of your profits. If they are too large, you may increase slippage and market impact. Professional traders incorporate transaction costs into their sizing decisions. They ensure that the expected return of a trade justifies the costs involved. This may involve setting minimum thresholds for trade quality, below which trades are not taken. It may also involve adjusting position size to optimize the balance between cost and return. Another important aspect is consistency. If transaction costs vary significantly between trades, they can introduce variability into your results. By standardizing your approach to position sizing, you can reduce the relative impact of costs. This is particularly important in lower time frame trading, where costs can accumulate quickly. Understanding the relationship between position size and transaction costs allows you to refine your strategy and improve overall efficiency. Position sizing also interacts with time horizon. Short-term trades and long-term trades have different characteristics, and this should be reflected in how positions are sized. Short-term trades often involve tighter stops and more frequent execution. This may allow for larger position sizes in nominal terms while maintaining controlled risk. Long-term trades typically involve wider stops and longer holding periods. This requires smaller position sizes to maintain the same level of risk. Professional traders adjust their sizing based on the time horizon of the trade. They recognize that different strategies require different approaches. Another consideration is exposure duration. Longer trades tie up capital for extended periods. This has an opportunity cost, as that capital cannot be used elsewhere. Position sizing must account for this. You are not only managing risk, but also allocating capital efficiently across time. By aligning position size with time horizon, you create a more coherent and efficient trading framework. As you bring all of these elements together, position sizing becomes a comprehensive system rather than a single decision. It integrates risk per trade, volatility, conviction, portfolio context, liquidity, transaction costs, and time horizon. The objective is to create a framework that is robust across different market conditions. This requires clarity, discipline, and continuous refinement. Every trade should be approached with the same structured process. Define the risk, calculate the position size, assess the context, and execute with precision. There should be no ambiguity, no emotional overrides, just a consistent application of your framework. Over time, this consistency leads to stability. Your results become more predictable, and your performance reflects your true edge. Position sizing is not about finding shortcuts. It is about building a disciplined professional approach to managing capital. When you master this, you move beyond the randomness that defines most traders. You begin to operate with intention, control, and clarity. And that is what allows you to scale your edge without blowing up. There comes a point where position sizing evolves from a rule-based framework into an intuitive yet still structured component of decision making. This is where experience begins to shape execution. However, it is critical to understand that this intuition is not instinct in the emotional sense. It is pattern recognition built on repeated exposure to markets, outcomes, and disciplined application of rules. At this stage, professional traders begin to recognize subtle shifts in conditions. They can sense when volatility is expanding beyond normal parameters, when liquidity is thinning, or when market behavior deviates from expected patterns. These observations feed into position sizing decisions, but always within predefined boundaries. The mistake many traders make is attempting to shortcut this process. They try to rely on intuition before they have built the necessary foundation. Without structured experience, what they call intuition is often just bias or emotion. This leads to inconsistent sizing and unpredictable results. True professional intuition operates within a framework. It refines decisions, but it does not replace the rules. For example, a trader may slightly reduce size in an environment that feels unstable, even if all technical conditions are met. This is not random. It is informed by experience and validated over time. Another aspect of this evolution is the ability to recognize when not to trade. Position sizing is not only about how much to allocate, but also about when to allocate nothing. Standing aside is a position. It is often the most disciplined decision you can make. As markets become more complex, this discretion becomes increasingly valuable. But it must always be grounded in structure. Without that, it becomes a source of inconsistency. When you reach this level, position sizing is no longer just a calculation. It becomes part of a broader decision-making process, integrating both quantitative rules and qualitative judgment. A professional approach to position sizing also requires clear documentation. This is often overlooked, but it is essential for developing consistency and improving performance over time. Every trade should have a recorded rationale for position size. This includes the risk per trade, the stop-loss distance, any adjustments for volatility, and any considerations related to portfolio exposure. By documenting these factors, you create a record that can be analyzed and refined. This process allows you to identify patterns in your behavior. You may find that larger position sizes are associated with poorer outcomes, or that certain adjustments consistently improve performance. Without documentation, these insights remain hidden. Professional trading is not just about execution, it is about continuous improvement. Position sizing is a key area where small refinements can have a significant impact over time. Another benefit of documentation is accountability. When you define your position size in advance and record the reasoning, you reduce the likelihood of impulsive decisions. You create a layer of discipline that reinforces your framework. This also ties into performance evaluation. When reviewing your results, you can assess not only whether trades were profitable, but whether position sizing decisions were appropriate. This adds depth to your analysis. Over time, this feedback loop allows you to refine your sizing framework. You move from a generic approach to one that is tailored to your strategy, your behavior, and the markets you trade. Stress testing is another advanced concept that applies directly to position sizing. It involves analyzing how your sizing framework would perform under extreme conditions. This is not about predicting specific events, but about understanding the limits of your approach. Markets can behave in unexpected ways. Volatility can spike, liquidity can disappear, and correlations can break down. If your position sizing framework is not robust, these conditions can lead to significant losses. Professional traders simulate these scenarios. They consider what would happen if multiple positions moved against them simultaneously, or if stops were not executed at expected levels. This helps to identify potential weaknesses in the framework. For example, if a sudden macro event causes several correlated positions to move sharply, your aggregate risk may exceed acceptable levels. By stress testing, you can adjust position sizes or portfolio limits to mitigate this risk. This process also reinforces the importance of conservative assumptions. It is better to underestimate potential risks. This creates a margin of safety. This creates a margin of safety. Stress testing is not a one-time exercise. It should be revisited regularly, especially as your capital grows or your strategy evolves. By incorporating stress testing into your approach, you ensure that your position sizing framework is not only effective in normal conditions, but also resilient in extreme scenarios. Another critical dimension is the relationship between position sizing and psychological resilience. Trading is not purely analytical, it is also deeply psychological. Your ability to execute consistently depends on your mental state, and position sizing has a direct impact on this. If your position sizes are too large, even small price movements can create significant emotional responses. This can lead to impulsive decisions, such as exiting trades prematurely or deviating from your plan. Conversely, if your position sizes are too small, you may become disengaged. The outcomes may feel insignificant, reducing focus and discipline. The goal is to find a balance. Position sizes should be large enough to matter, but small enough to manage emotionally. This allows you to stay engaged without becoming overwhelmed. Professional traders are highly aware of this balance. They understand their own psychological limits and adjust position sizes accordingly. This is not a sign of weakness. It is a recognition of reality. Another important aspect is consistency. When position sizes are stable, emotional responses become more predictable. This makes it easier to develop disciplined habits. Over time, this stability contributes to psychological resilience. You become less reactive to individual outcomes and more focused on the process. Position sizing, therefore, is not just a risk management tool, it is a mechanism for maintaining psychological stability, and without that stability, consistent performance is impossible. As your capital grows, position sizing introduces a new challenge: scalability. What works at a smaller scale does not always translate directly to larger amounts of capital. Larger positions can impact the market, particularly in less liquid instruments. Execution becomes more complex and the risk of slippage increases. This requires adjustments to both strategy and position sizing. Professional traders anticipate this. They design their frameworks to be scalable, considering how position sizes will evolve as capital increases. This may involve diversifying across more instruments, reducing position sizes in certain markets, or using different execution techniques. Another consideration is risk concentration. As capital grows, maintaining the same percentage risk per trade can lead to very large absolute exposures. This must be managed carefully. In some cases, traders may reduce their percentage risk as their capital increases. This reflects a shift in priorities from aggressive growth to capital preservation. Scalability also requires infrastructure. Larger positions often require better execution systems, access to deeper liquidity, and more sophisticated risk management tools. Understanding scalability ensures that your position sizing framework remains effective as your trading evolves. It prevents you from outgrowing your own system. Another advanced concept is the idea of capital allocation across strategies. Many professional traders do not rely on a single strategy. Instead, they operate multiple approaches, each with its own characteristics and risk profile. Position sizing must account for this. You are not only allocating capital within a strategy, but also across strategies. This adds another layer of complexity. Each strategy may have different levels of volatility, drawdown characteristics, and expected returns. Position sizing should reflect these differences. For example, a higher volatility strategy may require smaller position sizes, while a more stable strategy may allow for larger allocations. Professional traders often assign capital weights to each strategy based on performance, confidence, and diversification benefits. This creates a portfolio of strategies rather than a single approach. Position sizing becomes a tool for balancing this portfolio. This approach reduces reliance on any one method and improves overall stability. It also allows for more efficient use of capital. Understanding how to allocate capital across strategies is a key step towards professional trading. Technology plays an increasingly important role in position sizing. As markets become more complex, manual calculations and decisions become less efficient. Professional traders often use tools and systems to automate aspects of position sizing. This ensures consistency and reduces the risk of human error. For example, trading platforms can calculate position size based on predefined risk parameters and stop-loss levels. This removes guesswork and speeds up execution. More advanced systems can incorporate multiple variables, such as volatility, correlation, and portfolio exposure, to optimize position sizing dynamically. However, automation must be used carefully. It should support your framework, not replace your understanding. You must always know how and why position sizes are determined. Another benefit of technology is data analysis. By tracking position sizing decisions and outcomes, you can refine your approach over time. So creates a feedback loop where data informs decisions and decisions generate new data. Over time, this leads to continuous improvement. Technology is a tool. When used correctly, it enhances discipline and efficiency. When relied on blindly, it can create risk. Risk limits are the final layer of a robust position sizing framework. These are predefined boundaries that cap your exposure both at the trade level and at the portfolio level. Risk limits act as a safety mechanism. They prevent excessive exposure regardless of how attractive opportunities may appear. For example, you may define a maximum risk per trade, a maximum number of open positions, and a maximum total portfolio risk. These limits create structure and discipline. Professional traders adhere to these limits strictly. They do not override them based on confidence or market conditions. This consistency is what protects capital over the long term. Another important aspect is reviewing and adjusting these limits. As your capital strategy and experience evolve, your risk limits may need to change. However, any changes should be deliberate and based on analysis, not reaction to recent outcomes. Risk limits also provide clarity. They remove ambiguity from decision making and reduce the influence of emotion. When these limits are in place, position sizing becomes part of a controlled system. You know exactly how much you can risk, and you operate within those boundaries. This is essential for maintaining discipline and achieving consistent performance. At this stage, it is important to recognize that position sizing is not about perfection. There is no single correct approach that works in all situations. What matters is consistency, discipline, and alignment with your overall framework. You will encounter different market conditions, different challenges, and different opportunities. Your position sizing framework must be flexible enough to adapt, but stable enough to remain consistent. Mistakes are inevitable. You may overestimate risk, underestimate volatility, or misjudge conviction. The key is to learn from these experiences and refine your approach. Professional traders embrace this process. They understand that position sizing is a skill that develops over time. They focus on continuous improvement rather than seeking perfection. This mindset allows them to adapt and evolve. Another important point is that position sizing is deeply personal. It must align with your risk tolerance, your strategy, and your objectives. What works for one trader may not work for another. This is why it is important to develop your own framework rather than copying others. When you take ownership of your position sizing, you create a system that reflects your strengths and manages your weaknesses. Position sizing is the mechanism that transforms trading from speculation into a structured professional activity. It is the foundation upon which all other elements are built. Without it, even the best strategies are vulnerable. With it, even simple approaches can produce consistent results. The principles are clear. Define your risk, calculate your size, adjust for context, and execute with discipline. Repeat this process consistently over time. This is not about finding shortcuts or quick gains. It is about building a sustainable approach to managing capital. As you integrate position sizing into your trading, you will notice a shift. Decisions become clearer, outcomes become more controlled, and performance becomes more stable. You move away from emotional reactions and towards structured execution. This is the essence of professional trading. Position sizing is not just a technique, it is a mindset. It reflects how you think about risk, capital, and opportunity. When you master it, you gain control over your trading, and that control is what allows you to scale your edge, protect your capital, and operate with confidence in any market environment.